Welcome to Tradewinx software. Stress testing prospective stocks. 1. Determine the stock's current yield. Find out the company's most recent annualized dividend, then divide that amount by the current stock price. You want to look for stocks that have a fairly high yield relative to what? While you can compare a stock's yield to the market as a whole, this won't give you a whole lot of useful information because there are so many diverse companies and industries at play in the market as a whole. Comparing the stock to that of others in the same industry or market sector, on the other hand, allows you to compare apples to apples, rather than apples to oranges, as the saying goes, giving you more useful information. To choose a safe stock, you want one that's producing at or near the average yield rate for similar stocks in the same industry. 2. Calculate the stock's dividend payout ratio. If you take that annualized dividend figure and divide it by the company's annual earnings per share, you get the payout ratio. A lower ratio means the company could potentially raise its dividend. As with the yield rate, evaluate dividend payout ratios in relation to other stocks in the same industry or market sector. Some sectors, such as electric utilities, are established industries with slower growth. These typically have higher payout ratios. On the other hand, industries that grow faster, such as the tech industry, will have lower average payout ratios, because the companies have to reinvest in their business to keep pace with the industry and their competition. 3. Assess the stock's performance in times of crisis. To stress test a stock, you want to look in particular at the company's dividend payments over the last few years, particularly during the most recent recession. You typically can find this information by going back to the corporate website and looking for an investor relations page. Look for growth in payments, and determine whether those payments have been growing quickly. If you're focused on long-term investment, you want to favor a higher growth rate over a higher yield. A higher growth rate means you'll make more money later, which protects you. 4. Consider the probability of outside threats. Threats to a company's profitability often develop gradually and can be predicted in advance. If a threat is looming that seems imminent, it might not be the best time to invest in. For example, consider political debates about increasing the minimum wage. While raising the minimum wage significantly could improve a lot of people's lives, it potentially would cause damage to corporations such as McDonald's and Walmart that employ vast numbers of people at minimum wage. When these companies' labor costs increase, their profit margin will decrease, potentially causing a significant drop in the value of their stock. If you are looking to invest in an oil company, the situation in the Middle East should be a significant concern. If war removes oil supply from the market, even if demand remains static, the price of oil will increase dramatically. Give us a call +918 3910 94408. Register now www.stockbuysellsignal.com.